I really don't think any of these issues are a source of great concern for the market right now. The Iraqi situation could be a real concern for the markets if the ISIS forces overrun the oil production facilities in the south. That becomes a real problem for the markets because that could send the price of the West Texas Intermediate up to $120 a barrel or even higher, and that is going to take away from economic growth, and that's going to give the markets an excuse for a long overdue correction in equities. But my base case scenario is that Iraqi oil will continue to flow. ISIS forces will continue to be a source of instability, but they are likely to be stopped short of the oil production facilities in the south. Now, if that's the case, then oil's not a real source of concern for the markets, and we've seen a bit of instability in Iraq price into the equities market, into the currency markets, but nevertheless, the equities market continues to move up. Now, if you talk about China, I think growth in China has already probably hit a bottom. We've already established the floor for Chinese economic growth, and I think we're unlikely to see a systemic sort of risk coming up from China, highly unlikely to see systemic risk coming up from China. So that's not a source of concern. In terms of rates, I think that there is consensus that there'll be a first rate hike by the Federal Reserve sometime in the second half of next year. There is some argument as to whether it's June, July, or August, but sometime in the second half of next year, in the middle second half of next year, there'll be a rate hike. But I think that is already in the price. What is perhaps greater concern now is valuation. I think valuations in the U.S. market are no longer quite clearly, they're no longer where they were. If you look at the price to earnings ratio, that's running 2 times the index growth. That's expensive. And if you look at the price to earnings relative to where the VIX is, that's a high degree of complacency in the markets. That would be my main concern at this point in time. I think the U.S. Treasury, the 10-year U.S. Treasury yield has a couple of components to it. Partly, it's been subdued as a result of the economic data disappointment in the first quarter of the year, the first half of the year, and a large part of that was probably due to the weather-induced weakness in the U.S. economy. But there are also structural reasons why the 10-year U.S. Treasury yield is unlikely to move aggressively north, that the 10-year yield is likely to be subdued. Although it may make gains over coming months, it's unlikely to be of a large sort of order. And that's the net issuance of U.S. Treasuries over the past 6 to 12 months. They've been declining. They've been declining whilst demand from bond funds continues to at the rate it had been going. So demand and supply suggests that unless we see aggressive growth, economic growth surprising the market, the 10-year yield is likely to be subdued in the 2.5 to 3.